So let me ask you something. You bought your San Jose home probably 12 or 15 years ago. Maybe you paid $700,000 or $850,000, doesn't matter. Now you've been here and you've made your payments, and now you're looking at selling for somewhere north of $2 million. Now that's a great outcome, and that's real wealth. But here's the part nobody tells you before you sign that listing agreement. Depending on how you handle the sale, the IRS and the state of California could have a very strong opinion about a significant portion of that profit. Now we're talking about the tax bill that for some sellers could be north of $300,000. Now, quick note before we go any further, I'm a real estate broker. I'm not a CPA or a tax attorney. Nothing in this video is individual tax advice. What I'm going to give you is the landscape, the rules, the strategies, and the right questions to bring to your own tax professional. Now, every situation is different, and yours deserves a real conversation with someone who knows your numbers. Now, I'm going to walk you through exactly how this works, what the rules are, specifically what you can do to minimize what you owe. So here's a good example. Take a retired couple, both working in education their whole careers, teacher and administrator. Now they bought their house in 2004 for $480,000, and they were sitting on an offer just over $1.75 million. It's a beautiful outcome, 20 years of appreciation, and they were happy and ecstatic. A couple weeks before they closed, they sat down with their accountant for an unrelated meeting, just routine stuff. Now, the accountant asked how the sale was going and started running numbers on a whiteboard, and the room got quiet really fast. After the married couple's federal exclusion of $500,000, now they still had roughly $770,000 in taxable gain. Now that gain, stacked on top of their pension income for the year, pushed them into a federal tax territory they had never been in before. Now throw in California's tax rate, which does not give capital gains any special treatment. And by the way, it taxes it like regular income. And they were looking at a combined bill somewhere between $230,000 and $270,000. Now they closed their deal, they were fine, but they wished they'd known that 6 months earlier, not 6 weeks. Because there were decisions they could have made, timing decisions, documentation decisions, that might have changed that number meaningfully. Now flip that. Another seller in Willow Glen reached out to me before she even started thinking about selling. She'd done a kitchen and primary bath renovation back in 2019, and she kept every receipt. And she had some questions about timing, so we got her connected to a CPA early. Now she understood her adjusted basis, she understood her exclusion, but she timed her sale for a year where her other income was lower than usual. The bill still existed, gains of this size always generate some tax, but it was managed, planned for, and significantly smaller than it would have been otherwise. Same San Jose market, same basic scenario, two completely different outcomes based entirely on when they started paying attention. So look, the tax code around the sale of a primary residence is actually one of the most generous provisions for individual taxpayers in the entire tax code. There's a $500,000 exclusion for married couples that most people have heard of, but almost nobody understands that the full rules around it, and almost nobody is using all the tools available to them. That's what we're going to fix today. Most married couples selling a primary residence know they can exclude up to $500,000 of profit from federal capital gains tax. Single filers get $250,000. Now, that part everybody's heard. What they haven't heard is that the rules around qualifying have some flexibility that most sellers don't know to use. Here's what the IRS actually requires. You must have owned the home and used it as your primary residence for at least 2 of the last 5 years before the sale. 2 out of 5. And here's the part that surprises people. Those 2 years do not have to be consecutive. You could have lived in the home for 1 year, rented it for 2 while you were relocated for work. You could move back in for another year and you still qualify. Now the 2-year clock is cumulative, not continuous. There's also a provision called the partial exclusion. If you haven't hit the 2-year mark, but you're selling because of a job relocation, a health issue, or what the IRS calls unforeseen circumstances, you can still claim a proportional exclusion. Lived here 14 months out of the required 24 and got transferred to Austin for work, the IRS may allow you to claim roughly 58% of the full exclusion. For a married couple, that's still close to $290,000 in that excluded gain. Now, before you assume you don't qualify, talk to a CPA. The rules have more flexibility than the headline number suggests. And honestly, one more thing on this point that matters for a very specific group of sellers. If you're a surviving spouse and you sell within 2 years of your spouse's death, you can still claim the full $500,000 exclusion, not the $250,000 single filer limit. After that 2-year window closes, you're back to $250,000. Now that is a hard deadline that widowed homeowners in San Jose miss constantly because nobody tells them it exists. If this applies to you or someone you know, that clock is running right now. Here's something that almost nobody that's getting ready to sell understands. The number you pay taxes on isn't your sale price minus what you bought it for. It's your sale price minus your adjusted cost basis, and that number can be meaningfully different. When you sell your home, the IRS lets you add the cost of capital improvements to your original purchase price. That adjusted total is your cost basis. The higher your basis, the smaller your taxable gain. Nice, right? Now, capital improvements are permanent upgrades that add value or extend the useful life of the home. This would be a new roof, a new HVAC system, a kitchen remodel, a bathroom addition, or an ADU. It also includes new windows, solar panels, a permitted addition. Now, these all qualify. Regular maintenance does not. So painting a room, fixing a leaky faucet, replacing worn carpet, those are repairs, not improvements. Here's where San Jose sellers specifically leave a lot of money behind. Silicon Valley homeowners renovate constantly. A kitchen in 2018, a primary bath in 2020, a new HVAC in 2022. But if you didn't keep your permits, your invoices and receipts dated and organized and documented, the IRS will not take your word for it. A $200,000 kitchen and bath renovation that you can document increases your cost basis by $200,000, and it reduces your taxable gain by $200,000. So at a combined federal and state rate, that can approach 35 to 37% for a high income year. That's up to $70,000 you wouldn't owe. Now that's real money. Now if you renovated and don't have the documentation, start pulling what you can. Bank statements, contractor records, permit histories. Santa Clara County's portal goes back further than most people think. Even partial documentation is better than none. And if you're planning to sell in the next 2 to 5 years, start that file now. After close, it's too late. So I'll be real with you. This is the part where California being California actually costs people money in a way most sellers don't fully grasp. The federal government taxes long-term capital gains at preferential rates. Depending on your income, that's 0%, 15%, or 20%. California does not do this. California taxes all capital gains, short-term and long-term, as ordinary income. At the top end, that's 13.3%. There is no discount for having held the property for 30 years. So for a Silicon Valley seller, the real tax stack on gains above the exclusion looks like this. Federal long-term capital gains at 15% or 20% plus a 3.8% net investment income surcharge if your income crosses $250,000 as a married couple, plus California at up to 13.3%. Combined, that's a marginal rate that can hit 37% on the portion above your exclusion. Now here's where timing matters more than most people realize. The year that you sell determines what other income gets stacked with your gain. A couple where one spouse retired, took a sabbatical, or had lighter stock vesting in a given year may find their combined income sits in a lower federal bracket. The difference between 15% and 20% federal rate on a $500,000 taxable gain is $25,000. Now that's real money for a decision that costs nothing, just timing. So remember, you're not obligated to list in any particular month. If you're within 6 to 12 months of a significant income change, like retirement, a career transition, a year where vesting is lighter, that conversation with a CPA before you pick your listing date is worth having. It doesn't always move the needle, but sometimes it moves a lot. Now I know what some of you are thinking. This sounds like it requires a CPA, a financial planner, and an estate attorney just to sell a house. Now that's fair, and look, most sellers don't need all three simultaneously. but they do need a CPA, and they need that conversation before they sign a listing agreement and put their home on the market, not 3 weeks before the closing. So here's the reality. The median single family home price in Santa Clara County has crossed the $2 million mark. If you bought more than a decade ago in Willow Glen or Cambrian or Almaden, your gain is almost certainly above that exclusion limit. That means the tax is real, it's significant, and it responds to planning. A 2-hour CPA consultation before you list costs a few $100. The decisions that come out of that meeting could be worth multiples of that. This isn't complexity for its own sake, it's the math of where this market is. Now, my name is Kip, and I've been a licensed broker for over 20 years here in Silicon Valley. Now, besides being a top producer, I've sat on the ethics committee here for over a decade, and I've also managed and grown an office for the #1 brokerage in the country, and I've overseen billions of dollars in sales. And what I love more than anything is helping buyers and sellers here in Silicon Valley. And as always, I'm a broker, not a CPA. Take everything in this video to your tax professional before you make any decisions. How these rules apply to you depends on your specific numbers, and that conversation is worth having before you list your home to sell. What I can tell you from 20 years plus in San Jose is this: the sellers who come out ahead aren't always the ones who got the highest offer. They're the ones who understood their full picture before they made these decisions. The exclusion rules, their cost basis, their income timing, those things are knowable. They just require some attention before close, not after. Now, that's the whole point of this channel, not to sell you anything, just to make sure you're walking into one of the biggest financial decisions of your life with real information in your hands. If this was useful, subscribe. There's a whole lot more where this is coming from. Thanks for watching, and I'll see you in the next video.